morning and welcome to the first ever Mayar Capital Partners meeting, the London edition. This is our agenda for the day. I'm going to have a few brief remarks. I'm going to talk a little bit about the past year and some general comments, and then we'll started to get into Q&A. We've received a ton of questions via email. Thank you so much for sending them. And so I'm going to take a couple of questions first from the ones that we've received via email, and then we're going to alternate one question via email and one question from you until we're done. And I expect to have some closing remarks around 11:50 and get you all back to more productive endeavors by 11:30. I want to first start by thanking the Mayar Capital team for everything that they do for you day in and day out. I've been blessed with an amazing group of colleagues who are not only good at what they do, but just really pleasant to work with. And I'm forever grateful for that. I'd also want to especially thank Sophie for putting together this meeting and the Khubra Edition meeting and coordinating everything that had to be coordinated around that. I also would like to send special thanks to the rest of the team who work in the background, our outside partners and third-party service providers who also provide very valuable support and deep expertise and make what we do possible. We have grown. It's been 6 years since we started, when I was sitting by myself managing $1.84 million of assets, and at that point the 4 after the 8 actually was material to the assets. We've also grown in terms of number of investors. We now have more than 50 investors and assets under management of more than $55.5 million. All of this growth has happened through word of mouth and referrals from existing partners. I really appreciate everything that each one of you has done in that regard. I thank you so much for that, and it brings me so much pleasure that you are happy enough with the partnership and how things have gone to actually refer us to other people. And some great news on the growth front. We recently signed the deal with Diraya Financial to be a distributing partner of the Mayar Fund all over Saudi Arabia. We will be launching the marketing effort in this partnership with Diraya starting this month, and we're exploring similar partnerships in other geographies around the world. Our success as a partnership, as a group of people, both you, us, and everybody we work with, rests on 3 big pillars: our partnership principles, our strategy, and our process. Our partnership principles since day one have been the moral guide and the compass that we test our behavior and check our behavior against day in and day out. And our partnership principles, which we always put on the first page of every letter that we send out, promise you essentially 4 things. The first thing we promise is that we're going to be bending backwards in terms of how honest we're going to be and how we communicate with you. The second thing that we also promise you is to be aligned with you as investors. The third thing we promise is to focus our energies and our thinking on the long term, accepting short-term volatility to gain longer-term better results. And then the last thing we promise in our principles is to think about risk before return. The second leg that our partnership and success rests on is our investment strategy. And here we're essentially trying to buy wonderful businesses, great companies, but not overpay for them. And that's the second pillar. The third pillar is our checklist-based investment process. And what's special about our investment process is that it is based on a checklist process that helps us overcome behavioral biases that affect every investor. And one way that has manifested itself is how the checklist approaches the question of whether to invest or not. As you all know, our investment process inverts the question and starts with the goal of trying to kill the idea quickly. instead of trying to find reasons to invest, our process is trying to find as many reasons as quickly as possible not to invest. And by doing that, not only does it frame how we think about things from a behavioral point of view, but it also helps us approach things in a way where we bring the ugliness to the surface as early as possible. And that helps us become more rational about how we think about new investment ideas that we're looking at. So let's look at the past year. Over the past 12 months, the Mayar fund has gained by 17.25%. Wonderful absolute results, even if it's slightly underperformed the MSCI World for the 12 months. And that brings the performance since inception to 85.4% on a net basis, compared to a 66.6% increase for the MSCI World Index or benchmark, which translates into a 10.4 annualized rate of return for the Mayar fund, compared to an 8.6 rate of return on an annual basis for a benchmark, the MSCI. How did we achieve that? Let's dig deeper into our portfolio and see what it looks like and how it's evolved over time. So this is our preferred measure of geographic exposure. And what we're doing here is we're trying to look at our portfolio companies and look at the underlying revenues that those businesses are generating and seeing where they're being generated around the world. So we're looking at the geographies where the revenues is coming and using that as the best proxy of our economic exposure as investors, as opposed to conventional listing methodologies. And what you can see here is that throughout this process, while there have been some variability, we've been broadly exposed and broadly diversified around the world in terms of our economic exposure. This looks at our geographic exposure from a more conventional lens, which is the listing lens. And the reason I put this chart up is I wanted to highlight what happened to our exposure to the North American market, which is mainly dominated by investments that we've had in US listed stocks. And you can see that 2.5 years ago, it peaked at 82.7%, whereas at the end of the fiscal year, it bottomed at an all-time low of 46.5%. It's actually dropped a little bit below that right now. And the reason I want to highlight that is twofold. One, I want to remind everyone that when you're investing with us, part of what you're getting basically is a real active approach to investing. We are looking for investment ideas around the world. We are not being bogged down by how the benchmark is exposed in one way or another. We're thinking long term, and we're thinking flexibly in where we can find investment ideas. The other thing I want to highlight here is that this drop from 82.7 to 46.5% was not driven by a top-down view where we have sat around and decided that we want to cut our US exposure. This was purely a byproduct of our investment process. The way we decide how much exposure we have to any geography is that we will follow our investment process, which is going to give us investment ideas to invest in, and it's going to give us investment ideas that we should exit. And the interaction between the new investment ideas that we enter or add to and the ones that we exit or reduce will influence the bigger picture of how our portfolio looks like. And a lot of that is driven by very strict and disciplined approach to valuation. And what basically happened since 2014 till now is as US market valuations have gone up, our process has forced us indirectly as its byproduct to exit more and more US stocks, and as you can see, increase our exposure to some other geographies in terms of listings. Another thing to highlight here, which is again, we got in some of the questions, is how much cash has increased in the portfolio the past couple of years. And again, we're not sitting around here and trying to decide we should have 16% or 15% or 10% cash exposure. This is all driven by the interaction between new ideas that the investment process is spewing out and the ones that are disciplined in terms of selling is forcing us to exit. Again, industry exposure. This looks at the different sectors that the portfolio has been invested since inception. Nothing I don't have a lot to say about that except to say that it's a broadly diverse portfolio across industries. Even when we were moving our geographic exposure, we kept and maintained a broadly diversified industrial economic exposure throughout the world. And this is just a deeper look at how the portfolio ended at the end of the fiscal year on June 30th in terms of the economic exposure. It's in the annual report. We've got a few extra copies here if you want to dig deeper into that. But again, the message here is that this is a broadly diversified portfolio in terms of industries. Now, I want to look at some statistics that we've shared with you over the years and look at how it's actually evolved over time. The first one I want to look at is the price-earnings ratio, which is a very conventional way and frankly a shortcut to valuation. And we have here in red the Mayar Fund PE ratio and the MSCI World Index PE ratio. And the message you want to get out of here is that our portfolio historically has traded at about a similar and sometimes slightly higher portfolio than the benchmark. That being said, when measured on a free cash flow yield basis, our portfolio has historically actually traded at a slight discount, sometimes a big discount, to the MSCI World Index. Why does that matter? The reason that matters is that if you look at the types of businesses that we own, you can see, and the very low numbers here actually skew the chart a little bit, but you can see at the end, our portfolio ended with a return on equity of 15% compared to an 11.2% return on equity for the average company in the benchmark. We are basically buying above average businesses, in most cases significantly above average businesses in terms of quality, security, strength of balance sheet, but we're only paying average prices for them. And I think that's essentially a short way to explain what the outcome of our process should look like. And the message you take out of that is that this is what we've been doing consistently since inception. Now, we've got, I think, 18 or 20 questions that we received via email. So I'm going to try and go through a few of them, and then we're going to do a back and forth, like I said. I'm going to sit down for part of this, just because I'm getting old. So, let's see. So, first question. Some of the questions have been combined and some of them have been rephrased for clarity. In your principles, you state that you will communicate openly with partners, yet at the same time, you do not share deep-level thinking on holdings. Can you reconcile that? And why is it important for you not to share thinking on holdings? I think there are two main reasons why we don't do that. The more important reason and the more relevant reason is that it has to do with behavioral biases. Studies show that when you share an opinion, whether in this case it's about an investment or a political position or whatever opinion that you're sharing, studies show that when you share a position, defend it publicly, and give more details about it, something happens in your head, basically, and it makes it you a lot less likely to walk away from that position. We want to be in a position where, as Keynes says, when the facts change, I change my opinion. What do you do, sir? We want to be there. We want to be able to, if new facts come along and we discover that we've made a mistake, we want to be able to quickly turn around, change our opinion, and act decisively. There is no gain by sharing information at that level, but there's a lot to lose in terms of the harm that we can do to the investment process. The other reason that we may not want to share deep-level details on the holdings, although, by the way, the actual names of the holdings are in the audited reports, so you can see them. It's just we don't want to defend them or share specific details about them. The other reason is, while it may not have been relevant the past 5 years, we sure hope that it becomes more relevant in the next 5 or 6 years, which is as we become bigger, our actions in terms of the liquidity impact and constraints that we face when buying and selling individual stocks is going to become bigger. And sharing too much information about our activities beforehand may cause us to pay higher prices when entering new position than otherwise, and to get lower prices when exiting existing positions if other market participants figure out what we're trying to do. And because we don't want to do something now and change it a year or 2 or 5 years down the road, we've opted since day one to act in a way that we think can be consistent with what we do for the next 5, 10, 20, 50 years. I'm going to take one more questions from the emails and then throw it out to you. These are 2 questions that were combined. What is the biggest risk you see in the portfolio today? What keeps you up at night? And should we be worried? So in the very short term, I think the risk that our portfolio is facing is an underperformance risk. As you saw, our cash position has increased considerably. Even last week it was approaching 18%. We were able to deploy some money into an existing idea last week, so it dropped down back to 16. But the risk is if markets continue to go from mildly expensive to more expensive to extremely expensive to crazy expensive, it can all happen. That could happen. And in that scenario where the market continues to bubble up, our discipline in terms of valuation will cause us to probably exit positions. And in a couple of cases, the past 6 months, we have been taken out forcibly through acquisitions. So some of our companies were acquired. And with valuations where they are, we may not be able to redeploy all of that capital back into new or into existing ideas. So there is a risk that we may be sitting here next year with a much bigger cash position, a much higher market, and we would have lost on some of that upside. But that's a short-term risk that doesn't, frankly, bother me, because that would be a scenario where we're going to have more firing power and better defenses when the market in that scenario inevitably goes down. And we'll be ready to act quickly and decisively in redeploying that capital into ideas in that scenario. Now, in terms of bigger risks and things that worry, there are quite a few. But I would like to highlight that in many of them, the monetary impact on us as individuals or on whatever short-term harm could happen to the portfolio is the least of my worries. Things like what's happening in North Korea and how the Trump administration is dealing with it. Frankly, anything that touches the Trump administration, for that matter, and some of the things that are happening in other places around the world, especially in the geopolitical front, are worrisome for us as human beings, more so than us as investors. That being said, long-term economic and investment returns have and will continue to be driven by economic fundamentals. There's a great quote from Bill Nygren's 2016 annual letter. He's the fund manager at Oakmark Funds. And he talks about the past 25 years at that point, which is the period since inception for the Oakmark Funds. And he says, a lot of people will look around today and say, we live in a very volatile world, the world is crazy, risks have never been higher. But actually, if you think back objectively and look for reasons not to invest, at every point in time in the past 25 years, starting with Operation Desert Storm, he's American, we call it the Gulf War, the global recession that ensued, SARS, the Iraq War, Afghan War, coming after 9/11, the great financial crisis, ending with Brexit, and potentially other aspects. Over this period, will all these negative events, at any moment in time, someone rational and prudent could have sat down and said, here's why this is not the time to invest. And you would have missed out on a 9-fold increase in the value of the stock market. Was it volatile? Yes, it was. Very much so. But it's still, when viewed through a lens of a longer-term approach, which, frankly, most people should take. I mean, even if you are at retirement today, your life expectancy should dictate a much longer time horizon than people have when they're 18 or 20 or 30. Or at least that's the way they behave, as if that's the case in financial markets. Let's take one from the floor, and then we'll go back to some of the ones that we got via email. Who wants to start? Sam.
I want to ask 2 questions. One is, what's the average market cap in your holdings? If you want to share that. And what's your opinion about passive versus active investment? Especially with as technology gets stronger and stronger. So I'm not talking about just simply indexing, I'm talking about computerized investing, which is a bit different, obviously, than passive indexing.
2 very good and very hard questions. You could have started by saying I'm amazing or something like that. So the first one about Now I'll answer your questions then. Market capitalization. I don't have the number in front of me, but I can tell you that the market capitalization of our portfolio on average changes a lot. The past couple of years, it's increased substantially. It probably peaked with very big, larger cap holdings around the time the US was 82% of our portfolio, and has been declining ever since, at least in a relative sense. Some of our biggest positions now are what are considered mid-cap, so in the $2, $3 to $10 billion range, which was the case ironically 10 years ago. We are not approaching the problem trying to look at certain sizes. Like I said, in times where there are times where big caps are going to be cheaper, and there are times where big caps are going to be smaller. Small caps are going to be cheaper, and we're going to go where the opportunity set exists. In terms of passive investing, I think that's a very long question to answer accurately. The short answer is, I don't know. I don't think anybody knows. If you're talking about indexing, it would have been an easier question to answer. So maybe let me address that and try to find a way to build on it to get into the wider question. A big factor behind the increase in indexing has been that a lot of studies have shown that active managers have underperformed their benchmarks over many periods. However, there are a couple of studies that happened more recently that tried to dig deeper and try to figure out who outperformed and who underperformed. Actually, I have one here. Let me try to find it. Yeah. So in this study, they looked at active share, which is a measure of how different the fund manager's portfolio is from the benchmark that it's most closely resembles. And you can see in orange, this is the growth of indexing. There's another chart after that that looks at an expanded period, but it's the same message. And you can see that over this period, while indexing has increased, the top part of the market, which is basically the people who are true stock pickers in a sense, their portfolios differ materially from their benchmarks. This group has been a dying breed. And while indexing has grown and this group has shrunk, the group that expanded a lot, especially as you can see late 80s and into the 90s, are what you can call closet indexers. And those are managers that start with the benchmark essentially. If they don't like a stock, they'll take your money and go and buy a little bit less of that stock than the benchmark. And when that stock goes down based on their own prediction, they outperform and they get extremely happy and they charge you performance fees for that. And that strikes me as nuts. Luckily, this insanity is being resolved, and the bulk of assets that are being lost from active managers and moving to passive has been from this group. People who pretend to be active and charge active fees, yet essentially act as if they are passive. The message from this study, and I don't want to get into too much detail, is that if you're going to pay active fees, go to a manager who's actually active. Because, even if you look here, the yellow line is, sorry, the chart is small. The yellow line is the top decile in terms of active share, which is basically people who are actually holding differentiated portfolio. And people who have differentiated portfolio have actually outperformed. So active managers who do something different are outperforming and have outperformed in the past. Is that enough to be, is being different enough to outperform? No, it's not. You need other things in the managers that you pick. But one thing that you should definitely do is exclude managers who pretend to be active and charge active fees, yet go ahead and act as if they're passive. Unless you invest in a true active manager, way better off investing in a cheap index fund. Now, how does that translate into AI and how that impacts the passive debate? Conceptually, I see no reason why the activity of this top decile cannot, at some point in the future, be mimicked by a very intelligent computer. Is it going to happen tomorrow? No. Is it going to happen 50 years from now? There's a very good chance that that happens. And that'll be a good thing for investors overall, because that will reduce the cost. It will make markets more efficient. A big reason why we are able to outperform, I think, is that we use tools to overcome behavioral biases. And in theory, at least, intelligent beings, if we can call them that, AI, should not be biased, at least not in a conventional way that human beings are. And if everybody who's investing becomes perfectly rational, then we would be out of jobs. Let me go back to...
Aziz, so once you commit to a position, how often do you reevaluate the holding? Like if the terrain is changing, or like you said, some decision gets passed, trade agreements change, that kind of thing.
That ties into another question that we have here. So I think it's a great question. And we got a similar question via email. And I think they're related. And this email says, many industries, including ones you're invested in, are facing accelerated disruption. How do you position the portfolio for that? So in terms of how often we do it, in a sense, in an informal way, we're essentially doing it on a real-time basis. As new information comes in, we're always thinking about these things. But we have a very formal quarterly review where Aubrey and I sit together, go through every company that's reported. We look at each company throughout the reporting period separately, form our own opinions, and then get together at the end of the reporting period, compare notes, update our models, update our assumptions, and go and decide whether we should change them. Sometimes we don't have to. Actually, most times we don't have to. But we go through them one by one.
Can you think of an example when you
Where we change our opinion mid-quarter or end of quarter?
Just, news happened, something profound that shook your opinion in the company for whatever reason.
It is very rare that we're going to sell something on a news headline.
Yeah.
99.999% of news headlines do not matter. There are very few cases where it is relevant. So, for example, Scripps Networks, which we own, got acquired, or got an acquisition offer from Discovery Communications recently, and that caused us to sell the stock on the day. That's an extreme case. Most of our trading happens after the quarterly review. Much more important and profound questions happen then, but also more importantly, we're not making decisions in isolation. So we're not looking at this company, but also we're looking at this company, other companies that we own, and companies outside. And it's in the interaction between these where decision making has to happen. When you say, I don't like whatever, SNI in this case, you're essentially saying, I either don't like it relative to everything else that I own, which means sell SNI and buy everything else, or do you not like it and would rather have cash, or do you not like it and rather buy some other things that we don't own? It's in the interaction at the portfolio level that I think the question matters more. But tying it into the disruption question that comes in, yes, we are exposed to many industries, retail, media, the packaged goods industry, where there are a lot of changes, especially the past 2 years. There are many reasons why that's happening. Some of them are demographic, and some of them are economical. I think people underestimate the economical ones. The massive monetary expansion that has happened since the great financial crisis has brought down the costs of capital substantially, to the point where many new startups have almost zero cost of capital and almost infinite access to capital. And what that does is, and we used to be in a co-working space with a lot of tech companies, so we essentially saw that in real time. You can start a business today and disrupt an existing competitor by engaging in what is essentially non-economic behavior, which is basically when you give away a product with no expectation of getting anything in return. I consider that non-economic behavior. And an existing incumbent could go out of business because they are actually in a business of making money. And that creates an environment where disruption goes up a lot. The consumer benefits in the short term. But what happens if and when interest rates go up again and the new disruptors have no business models, and the old providers of what could be essential services no longer exists? In theory, someone else could come again and go back to the old business model. But I think that's an interesting question to think about. The impact for us as investors is, if there was ever a time to buy and forget, this is not it. We have to constantly be thinking about how activities not only inside the industries we invest in, but also outside the industries interact with the businesses that we own and the competitors and other industries. And it also blurs the line between different industries in many cases. What that ultimately does for us in terms of decision making is that it means we have to simulate the future in more ways, think of many more scenarios than otherwise, and think how our businesses are going to look like, how are they going to interact in that future scenario, and are we happy with those multiple worlds or multiple scenarios? And that then feeds back into how we approach the question of both valuation and portfolio construction. In valuation, we may demand a fatter margin of safety, a cheaper price to make an investment. And in terms of portfolio construction, it may mean that we have hold a smaller position than otherwise, but also think about the interaction between all the different positions that we have and how their risks interact and correlate. It was the next one. How much cash do you typically hold, and how do you decide on that? I think I addressed this question earlier. Like I said, we are bottom-up investors. We believe that our investment process is going to give us new ideas to invest in and tell us which existing ideas to exit, add to or subtract, obviously, too. And we view cash as a byproduct of that investment process. Now, once cash is in the portfolio, we view cash for its option value. And that means that holding cash has costs, obviously, by missing out on upside, but also has the benefit of giving us the option to invest in something in the future. And if you think about valuations across the market cycle, as valuations come up, if you knew that the market is going to go down by 50% tomorrow, you definitely want to hold cash. But people think that they want to hold cash only because they think cash is going to protect their downside. I think there's an even more important reason to want to hold cash at that point, which is cash is going to give you the ability to buy stuff that you really like, that you've been waiting for, at much steeper discounts. And as the market cycle progresses, and we find fewer and fewer existing options, we think of cash as us comparing today's options to tomorrow's options, today's opportunities to tomorrow's opportunities. And so we're thinking, in a sense, across time and across investments, and trying to decide not only which investment is best for me to make today, but also which investment may be better for me tomorrow. And there may be scenarios where you should hold cash, where essentially, in our case, the investment process is telling us there is an investment opportunity that's going to exist 1 or 2 years from now, and the cost of forgiving whatever return for the next 2 years is going to be more than compensated by how much you're going to make by being able to buy that investment at a much lower price from now. Let's take one from the floor. Mark?
Just like a related question to your cash position is, do you hedge the portfolio for FX or markets? And that, in context of your cash position, is it possible to predict how your portfolio will perform in different market environments?
We have the ability to hedge, though we almost never do. The reason that's the case is, our third partnership principle is that we will focus on the long term only and will ignore short-term considerations. The overwhelming benefit of hedging comes from short-term considerations. So that's basically the conceptual reason why we may not want to hedge. A position where we may want to hedge is if we are exposed to a currency that does not fit within essentially a diversified portfolio, and we have no opinion on that currency. The problem with that is, we used to own an Indonesian company 2 years ago, and we didn't have any particular position on the Indonesian rupiah. But the problem with that is those currencies that are in that position also happen to be currencies that are very difficult to hedge. And so while in theory we may want to do it, in practice it's not doable. And so we just deal with it by sizing the position accordingly, knowing that we have taken a risk indirectly by not having a position on the currency. What was the second?
And then your performance in different market environments.
Yeah, the overwhelming points of outperformance for us has happened in down markets. Our portfolio has outperformed the benchmark in 72% of periods where the benchmark has declined, which you should expect given our conservative nature to valuation. But that's also why our strategy could struggle if you had a market like the past few months where it's shooting straight up. And that applies to most value strategies, I think. You're going to be in a position where you need these down markets or volatile markets, which are normal markets, to be able to capture that differential alpha in down markets. And we're happy. Historically, basically, we've massively outperformed on the downside and matched or slightly underperformed on upside markets. The most extreme case of it happened in the Great Financial Crisis, where we outperformed the market on the downside. The market was down almost 40%. We were down 24%. And the reason that's important is that the upside from a much lower drop is easier. If you lose 50% of your money, you need to double it to break even. And so in 2009, by the end of 2009, we had already broken even to our 2007 level. It took the market another 4 years to break even, which meant that gave us 4 years of making money above the benchmark.
And was that, do you think that was mainly a valuation argument, or is that also a function of your capital? The capital structure of your portfolio is presumably stronger.
We had almost no cash.
But the companies are less leveraged, presumably, than...
For sure. I mean, back to the earlier part of the discussion, when we looked at the return on equity of our businesses not only earn substantially higher returns on capital, they have substantially better balance sheets. The bulk of our portfolio companies are net cash. And that definitely helps on the downside. The reason it helps on the downside, which is even more important than the stock not going down, is that it gives them the option to invest counter-cyclically. If a company is surrounded by competitors that are bleeding, has substantial cash and access to debt, they can acquire companies, they can acquire customers, they can invest on the cheap. That's the type of business we want. One of the questions in our checklist actually looks at the behavior of management and whether they've invested counter-cyclically in downturns. A perfect example of one of our biggest holdings is Henkel, where you see the balance sheet expand in downturns and then shrink as the economic cycle goes on. And so they invest essentially against the cycle, taking advantage of downturns to make aggressive moves that competitors cannot make because they're reeling in their positions. One from the emails. Buffett recently admitted to having gotten Amazon wrong. What stocks do you kick yourself over? How much time do we have today? Many. Many. I think, though, we have a poster at our office that says no FOMO, no fear of missing out. And that is extremely important if you want to do, if you want to have an approach to investing like the one we have. We are essentially, like I said, back to our investment process. We said we want to kill the idea quickly. We want to find reasons to say no. We want to invert the question. That doesn't come for cheap. Protecting our downside has a price. The price is we're going to miss some upside opportunities. And we are willing to pay that price. We have to be willing to pay that price psychologically more than anything, because this is when funny things can happen in your head. Essentially, to avoid mistakes of commission, you have to accept mistakes of omission. And the results have worked for us, as they have for Buffett in the past. And you have to decide as an investor which mistakes you'd rather make. We just prefer to err on the side of caution and avoid blow-ups. And if the price is we're going to miss an Amazon every now and then, well,
At what price would you buy Amazon?
I mean, Amazon specifically, I don't kick myself over because it would fail one of the few checklist questions for us, and so that's not a stock that I kick myself over. There are a few that I do, things that were within our circle of competence would have passed, but we missed them, and it's gonna happen. I mean, there are thousands and thousands of companies, and we only remember the ones that have gone up by thousands and thousands of percent. We forget all the ones that haven't, and nobody knows their names. And so I think that's the byproduct of what we do. And we have to live with that. Especially none of you is going to know the mistakes of emission, right? I mean, we're not going to write to you and say, see that stock and that stock and that stock. We did not buy them. But we know. And I think this is the difficulty for us. And this is why we have the poster that says no FOMO. Okay, one from the floor.
Okay, Aziz. Thank you for the presentation and the gathering. I just have a couple of questions regarding the portfolio. Are you considering some alternative investments in the future to utilize the cash that you have in the portfolio, plus leverage? Are we even considering getting leverage in the future? And after signing with Diraya, I think if not for the fund, for the investors themselves, Diraya, I remember that they offer some leverage to their clients. So is it going to be for Mayar fund or not?
Okay. So in terms of alternative investments for the cash, like I said, I think we're very happy. We have a long list of companies that we wish to buy at a certain price. We walk around with this list. We update it every quarter, sometimes more than every quarter. And those are companies that if they hit a certain price, we would be able to buy within seconds. So we're ready for that. And I know there will be a downturn at some point. It may be tomorrow, it may be 5 years from now. I don't know about the timing, but I know when that happens, we're gonna find investments for that cash that will be lucrative enough to pay for holding cash now and doing nothing and earning nothing on it. We want to keep that option, especially at this point of the cycle. We want to be able to act decisively and quickly when that happens. Another reason we don't want to do alternative investments is we don't dabble in things that we don't understand. We have what we think is a relatively limited set skill. We don't understand everything in the world. We can't do everything, can't understand everything. There may be people who pretend that they do. There may be people who do. We don't. And so we're not going to engage in an activity where we are not fully confident that it's within our circle of competence. On the issue of leverage, we don't use leverage at the portfolio level. And the reason that we don't do that is one of the key things. It's in our partnership principles, but I think it's key to investing in general, especially the type of investing that we do. We have to understand and get a handle on the business. We have to understand and get a handle on the valuation. The third element of timing is, again, one more element to add, which is difficult in of itself, but I also think is one of the hardest one to get a handle on. And so we would rather not have to solve the question of when X will happen, as long as we are confident that X will happen and we'll make money in that scenario. And the problem with leverage, at least at the portfolio level, is that it introduces the element of time through the back door. And it makes it so investments not only need to behave in a certain way, but they need to behave in a certain way at a certain time. And at the very extreme scenario, leverage puts you in a position where you have to sell investments at the precise moment when you should be buying investments. And so if you engage in an investment approach that requires you to be opportunistic in buying in times of downturn, I think leverage handcuffs your hand. So that's why I don't want to do it on the portfolio level. Now, can investors do it at their end? I mean, for the same reason, I don't encourage it. And I think we have done well and will continue to do well without leverage. And I don't think you need leverage to do well over time. I think compounding will take care of that. That being said, I know a few investors who use custodians to hold our fund, and they have some leverage on that end. And that's their decision and their financial advisor's decision, and it's not my position to get into that. And on the Diraya question, finally, Diraya will, in my understanding, act as custodian again for those units for the investors that they bring in. And so in theory, and you'd have to ask Diraya themselves, in theory, they could leverage on the Diraya side of things. I don't know. For us, they're going to come in as straight investors. 3 questions that were combined here. What's the fund's future prospects in relation to the global economy? The U.S. market has gone up so quickly. Does that mean it's going to go down just quickly? And if yes, how are you going to mitigate this risk? And what's your view on the global economy and the valuation of the U.S. stock market? As you all know, we don't make market predictions and we don't make economic predictions. And the reason we don't do market predictions or economic predictions is in order for these predictions to actually become profitable, you need 3 conditions to be met. The first condition is you need to hold a differentiated position, which is hard, or a differentiated opinion about something. The second condition that needs to be satisfied is that differentiated opinion needs to be right, which is really hard. And then the third condition that needs to be met is that you need to find a way to express that correct differentiated opinion in a very clear and directly related matter in the form of an investment. And we don't think that I don't have the skills to do all 3. Can it be done? I don't know anyone who's been able to do it. But in theory, maybe an AI could do it. I don't know. I know I can't. And so again, back to what we said earlier, we're not going to go and try to do something that we don't know how to do. And instead, in terms of the drop and how quickly it happens, yes. I mean, historically, market drops have happened at an accelerated pace relative to market gains. However, one thing to keep in mind, the early stages of the snapback from drops have also happened at a very accelerated pace. And so it's very tricky to try to decide whether you're going to try to time it to go in and out. And I think there's another question that's coming up about that. So I'll leave it until that question comes up. But I personally think it's impossible to do. Take one from the floor. No more questions from here? Should I start naming names? Okay, let's take one more. In the annual letter, turns out to be the next question. In the annual letter, you say that the market will drop by 20 to 30% soon, yet you tell investors not to sell their holdings. Can you please expand on that? I don't think I said soon. I said it will happen. I just don't know when. Over the past 100 years, the S&P has declined by more than 10%. I'm just using the S&P because the data is easy to find. The S&P has declined by more than 10%, which is what people call a correction, roughly once a year. And has had a 20% or more decline every 3.5 years, or what is known as a bear market. And those have averaged about 10% in length and took 15 The first one, the corrections have lasted 10 months, and the bear markets have lasted 15 months. But there's substantial wide variability in terms of lengths around these. And so, and like I mentioned earlier, usually the snapback is quick. What we do know is that timing these things is extremely difficult, if not impossible. And I'd rather engage in more productive behavior, preparing for that drop instead of trying to time it. And the way we prepare for that drop is to build our wish list. The time to do research on new investment ideas is not when the stock is cheap. The time to do it is when the stock is expensive. If anything, that's the best time to do it, because you're not trying to act quickly, which can also mess with your head because it's cheap and you feel like you need to do something. I'd much rather look at a company when it's expensive and get to know it and spend the time. So a lot of what we've been doing the past few months is try to find companies that we like regardless of valuation. Back to our investment process, if you remember, the last thing on the list was valuation. Valuation is extremely important, but it doesn't mean that it's where you spend the bulk of your time, and you definitely shouldn't start with it. And so what we're doing now is adding more companies to our wish list, knowing everything that we can know about them, and assigning a price where we'd be happy to buy. And that list is expanding. And even though the general market is expensive, in fact, a few names that we've been looking at, and some of the names in our existing wish list are not too far from a price where we'd be ready to act. And as I said earlier, in spite of the cash going up, we've actually been able to deploy several percentage points into new and existing ideas just in this year. And just as what happened in 2016, where you had an almost 18% drop. People forget about that, but in early 2016, we had an 18% drop. The same thing happened in 2014 and 2011. In those cases, there were a couple of months to act. And trying to research companies at that moment in time, in the midst of things, is very hard to do. And so we are prepared. When the market drops, and I say when, we'll be ready to act decisively and act with size. From here, questions? Bracken?
It may not be Mayar specific, but I just had a couple of thoughts, and I'd be curious to know what you think about going back to the AI and the passive question. It seems to me that artificial intelligence for investing would work really well, provided there's no human beings in the world. It's all robots investing for robots. I think when you introduce things like managements who try to hide things in the 10K and 10Q.
They do that?
Just when in a world where it's still important to go and meet managements and see what they're like in person and develop an opinion as to their character, I think there's always going to be a place for that. And I think passive investing, which I guess is what you'd say is a very crude type of artificial intelligence investing. I wouldn't even say it's a voting machine. It's more like survey monkey, or these ETFs. You're basically magnifying the impact of the herd. You're not making the herd any more intelligent. And I think that in a place like that, over the long run, there's always going to be room for someone who can think for themselves. Although there aren't that many people in the world who fit that kind of thing. But I guess what I'm saying in very long-winded ways, I'm skeptical of the whole AI thing.
You're making an assumption that they can't read the 10K, and that's not really AI. That's very...
all I was saying basically is I'm open to the idea that at some point in the future, and they could exist. I don't know. I like I said, I don't think it's going to happen anytime soon. But I'm open minded enough to think that that future may exist. I don't know. On the issue of passive, Jason Zweig, who is a Wall Street Journal, writes the Intelligent Investor column in the Wall Street Journal, and edited the last couple of copies actually of Ben Graham's Intelligent Investor. But he's also a massive advocate for passive investing and has been for years. And what Jason Zweig says about that is basically, is passive investing what a lot of people should do? Yes. Is passive investing what most people should do? Yes. Is passive investing what everyone should do? Absolutely not. And it would be terrible for the economy and any country to have all of its assets passively held. But that won't happen as fewer and fewer active investors exist. Think of the last activist investor standing. It'd be massive arbitrage opportunities and way to make money for the last person and the last two and the last three. And there is a level where I don't know the number of what a sustainable and economically efficient percentage of passively held assets should be. It's probably not 0, and it's definitely not 100, but I don't know where the number is. Let's see. I've noticed that over the past year, Mayar Fund data has started showing up on many websites such as Morningstar, Bloomberg, and the Financial Times. In addition to performance, these websites show other information such as peer information and risk statistics. How much attention should we pay to these details in evaluating a Mayar Fund or any other fund that we may be interested in? I'm not a huge fan of risk statistics, mainly because I think they get abused and not all risks can be quantified. That being said, they do serve a useful purpose in some cases, and they may help explain things when comparing maybe one fund to another, one strategy to another. The problem with a lot of these websites is a lot of these statistics are being computed against either benchmarks or, in many cases, peer groups. And you have to be very careful about the peer group sample that these websites are using, because they may not always be represented. For example, the FT shows Mayar Fund as the 4th or 5th best performing fund in its global peers. Maybe we're 7th. I think we are probably top decile. I don't think we're 4th or 5th. But I think it's just the peer sample that they're using may not be big enough or representative enough of our peers. So just keep that in mind. And in many cases, I've seen some of them, the peer is just not the right label, which is very tricky because there are a lot of funds, us among them, where labeling things can get tricky, and they need to label things in these websites to be able to throw them into buckets and databases. But I mean, we're happy that our performance is out there and being published on these websites. It's definitely good for marketing. But just look at these websites with a grain of salt. They're useful, but remember that.
How do those websites? Is it the publication's prerogative to display certain funds? Like what's the interaction between the fund administrator and the publication?
There are many ways where the data gets on these websites. There's self-reporting data. Actually, the bulk of it is self-reporting at the core. And there are many data distributors where our fund administrator would be reporting the data to them, and then they go ahead and they may feed different websites, and then some of these websites will go and capture the data from these databases. Some of them will get the data directly. I mean, Morningstar, I know, gets the data directly from us. I know Bloomberg gets the data directly from us. I actually think the FT get their data from Morningstar, but somehow has slightly different data. I don't know why that's the case. But yeah, there are many paths where they end up there, especially on the ones that are open to the public.
There are no transaction flows from funds to the publications or vice versa.
No. Are you asking if we pay them?
Yeah, or
No.
yeah, or there's
No, we're too cheap for that. You had one from the floor. Let's do one from email. I've seen several of your talks on YouTube and heard more frequent podcast interviews with you over the last year, Aziz. Is this something you are dedicating more time to now? And if so, why? I think it is our duty as managers and as fiduciaries to explain how we think about things. Not only to our existing investors, but potential future investors. It is our job, ideally, not only to manage money, but to also inform and educate everybody who's in our circle, whether they're an investor or not. And so a lot of what we do in the quarterly letter, for example, is trying to address that and educate our partners, educate everybody who has access to the quarterly letters. But the quarterly letters may not be enough. And so some things could be addressed differently in the public forum, whether it's a talk at a university or an interview or things like that. Another reason to do it is, I think, in many cases, at least applies to me, I find that many times I understand something better if I put in the effort to explain it to someone else. So I find that very helpful. And again, it definitely helps with marketing the fund. That being said, you should be worried if you put on CNBC or Bloomberg every day and find me there. That should be a red flag. Question from the room? Okay, one more email. I noticed that Mayar Capital has won several awards lately, although you did not discuss these in your annual report. Could you elaborate on these and tell me more about them? I think the reason we may not have talked about it in the letter is that the rewards weren't Morningstar Manager of the Decade award. Let's be honest here. So that's probably why we didn't brag too much about it. It's really nice and it feels really good to get recognition from peers. Many of these awards are ones where you need to be nominated by others in the industry, and it's good to get that recognition, even if we're not doing what we do for the awards. It feels good for me and the team to feel that others in the industry are seeing what we do and appreciate it. One here? I keep going? All right. Many value investors have struggled in the past few years. Some have argued that value investing is dead. What's your opinion? That's definitely, I think there is an actual report from Goldman Sachs that says something like value investing is dead. Or something along those lines. That's definitely been going around. There's a chart, which is this one, that I shared with you in the September 2016 letter. We've just updated it with new data since then. But let me explain again what this chart is. This looks at the 10-year rolling performance. So at any moment in time, it's looking at 10 years of results, annualized, of the MSCI World Index value segment compared to the MSCI World Index growth segment. Now, there have been tons and tons of academic studies that have looked at 100 plus years of data that show that, on average, when looking at periods like these, 10 years plus on a rolling basis, value investing tends to outperform. And you see that with the exception of a small blip around 2000, which is, you can see this. Yeah, but around the small blip during the tech bubble, it's been fairly consistent around the 2 to 3 percentage points level of outperformance. And then the financial crisis happened, and we see value investing coming out, especially post 2010, massively underperform. And there are three takeaways to take from this chart, I think. One is you have to be very careful about what you call value and what you call growth. And so some of the things that we own in the portfolio are very traditional, what someone would call value names. But then we own Alphabet, for example, and we've owned Visa and MasterCard. And so optically saying this has a high PE, this is a growth stock, or this has a low PE, this is a value stock, I think is not very useful. The other thing to take out of this is it may not be a coincidence, and I think in the same letter I shared some data on the correlation between this chart and where 10-year treasury rates are. So it may not be a coincidence that this massive underperformance of value the past 6 or 7 years also happened in a time of massive monetary easing. And so, again, ties back to something I said a few minutes ago about cheap access to capital. And the two do seem to have some correlation. The level where it is today, and I think this data is up until end of July, is only slightly above the all-time low set last year. And so I'm inclined to think that this is a chart that will eventually mean revert. There's just so much data around the world across time that supports the period before 2010 as normal for the comparison between these two strategies. But I have no idea when that will happen. I would have expected that would have happened by now, given that rates have already started to increase and economies have already started to recover. But I'm not ready to say this is a new world that we live in and this time is different. You mention assets under management in your letters regularly. Why should I, as an investor, care about the firm or the fund's assets? And another question that we combined with it is, at what size assets would you expect to close the fund to new investors? Sit your mouth. I pressed the button. I mean, we've talked this at a couple of letters in the past. The way to think about this question, I think, is there are benefits to size and there are drawbacks to size. On the benefits side, as we get bigger, we gain economies of scale in many operational aspects, especially in terms of the cost of custody. John is looking at me. He works for Northern Trust. Cost of custody, execution costs. Jeffrey is looking at me here. Administrative costs. There are a lot of economies of scale that come to the fund as asset size increases. So basically, the total cost of investing $1, if you have 100 million, is a lot cheaper than the cost of investing $1 if you have 1 million in assets. So that's one big chunk that gives us substantial economies of scale up to a certain level. And the other benefit that comes from size, but at a much higher level, is access to deals that the average investor may not have access to. This is a much higher size, and obviously a theoretical question, a theoretical comment to make about the fund today. But think of Buffett getting access to deals during the great financial crisis by providing liquidity to Goldman Sachs or to GE or later to Bank of America. That obviously happens at a much, much bigger size. On the drawback side, however, there are drawbacks to size. As the total amount of assets grows, the universe shrinks. The opportunity set of where a fund can invest becomes smaller and smaller because a $10 billion fund cannot invest in a small cap. Though a lot of that relates substantially to the type of strategy that you're running. A fund such as ours that holds some investments in some case for 10 plus years may not worry a lot if there is no daily or weekly liquidity on all its positions. But it does become a problem and it impacts how quickly you can get in and out of positions essentially. And so that's another a drawback to size. And on the management team side, there are also drawbacks to size. There are benefits up to a certain scale. You can get more heads and more efficient. But at some point, you end up with too many people at the firm. Someone needs to manage them. You need to recruit people. You need to always find new people who are competent and at some point that becomes a challenge and a drawback to size. As it relates to us, I think our portfolio today can scale very easily to about $500 million. I think with small tweaks, we can easily get to $1 billion. And I also think that in what we do above $10 billion, it becomes challenging. And the drawbacks outweigh the benefits. Between the 1 billion and 10 billion levels, I think there are certain environments where the pros would be bigger than the cons and vice versa. And so to address the second question about closing the fund at what size, I think as we approach the 1 billion mark, that question is going to be one that we have to address seriously and look at the market environment. And one solution that people have done in those cases is to have a close but be able to open when market environments are conducive to that and then return capital when they're not. But I hope we face this bridge very soon. Anyone from here? Bracken?
Is there like a magic number of positions above which you'd never go?
I mean, we try to hold somewhere between 20 and 30. Historically, we've rarely dropped below 20, and we've rarely exceeded 30. I'd say it becomes really hard to hold more than 30 meaningful positions. That being said, we frequently ease in or out of a position, and so we'd be selling out of a position slowly or buying in slowly. And so if you don't count these, and those are and why we ended up in many cases at slightly above 30. But I wouldn't want to hold more than 30 positions that are full positions. And then the other thing that we try to do is our top 10 higher conviction positions, we'd like to deploy material amounts of capital to them. And so they're usually anywhere between 50 and 70% of the portfolio. No, so.
Just a question on the back to the cash dividend that you mentioned earlier. So this is another argument that people also throw sometimes. So given the current market environment and high valuation, not only in public equity, in private equity, and venture capital now, or the cheap access to capital, there are some thoughts that still, of course, the growth strategy has outperformed the last few years, given the cheap access to capital. but people still think that the increase in the interest rate will be at a slower pace than, for example, 15 years ago. So the high valuation period that we live in today might continue further. So you've mentioned that the academic report, for example, that it says 3 years, 10% and S&P 500 will also decline almost 10% every 2 years. This might not be the case going forward, given the current economic outlook globally. So, and this will put the pressure again on the value investing strategy. So so then the discussion comes in, are we timing the market? And you said, no, that I don't time the market, and no one can predict the market. So do you think, my question is, do you think the value investing will start to accept higher valuation now compared to value investors, for example, 10 years ago?
I think that's an excellent question. And a very hard one, honestly. In the short term, we have had 10 plus declines. And I'm working off memory here. I know we had one into 2016. We had one in one day, August 24th, 2015. Though that was very brief, I think lasted 2 hours. And then we still may have ended up during the week with a 10% decline. We had a 10% in April, or a drop in April or May of 2014, I think. We had a brief one in 2012, and we had a massive one, again, high double digits in the summer of 2011. We've had them. Just because we did not have another financial crisis doesn't mean we haven't had drops. The other thing is we've had drops of material magnitude in individual stocks. And so even if the market, we've been able to deploy money into individual ideas even as markets went up and up, because individual stock names we have gone down. The beauty of having a 20-30 portfolio name is you don't need to come up with 100 different ideas every year to deploy capital. So I think that's the question for us, and I'm confident that we're going to be able to find ideas. We may not find them today or tomorrow, but over time we'll find ideas. I'm not worried about that. And if we can't, then that's basically the market telling us not to invest. That leads to your second question, which is, are we just using the wrong ruler to decide what is an attractive investment idea? One of the things that we say is, if presented with an attractive investment idea that's going to make us a satisfactory return over the next 5 years, we don't care what happens next year or the year after that. But then what do we define as satisfactory? The definition may change. People think that mean reversion in rates are inevitable, but actually Japan has had very low rates for 26, 27 years now. And that is conceivable. We've only had 6 or 7 years of very low rates on dollars and less on other currencies. So in theory, we could have 20 years of very low rates. And in that environment, where you earn 2% on U.S. Treasuries, substantially less on other currencies, buying stocks and making 5%, and inflation, and that a corollary that an inflation in that world will also be substantially lower. And so you may make 5% on stocks in that environment with 1% inflation rates, while interest rates are at 2%. That's not so bad. If I'm going to hold something for 20 years, I sure as hell prefer to make 5% on it as opposed to 2%. I don't know. That's the real answer. I hope that's not the case. So this is something very odd about the current market. If you accept that, then the equity markets globally are actually very cheap. They're not slightly cheap. They are very cheap. I'm not there yet, but like you said, maybe at some point value investors are going to accept it. I don't see the argument why it would happen. Let's just say that. But that could change if more information. I mean, some people have pointed to demographics and other factors. That may change. But if anything, I think the information that we've been getting the past few months points in the other direction, and that it's not that the stock market is cheap relative to bonds. It's that bonds are crazily overvalued. One from email. This year you opened new custody and brokerage accounts with new providers. Why? This ties into the earlier question about benefits of size. Being able to diversify service providers, have better access to different markets, and better pricing on many of these things. It becomes cheaper, more efficient, and safer for us to invest, and gives us more options. So that's the reason. It's exactly a directive what we were talking about earlier. One from here. Should I get one from the email? Okay. The fund added multiple share classes over time, especially this year. Why? And the question that was tied to it is, when will the fund start paying a dividend? I'll answer the second question first. We're actually going to launch an income share class very soon. We got a lot of demand and requests from existing partners. And partners can move between the different share classes as they please. It'll pay 2% a year in dividend. And it will exactly underperform the A class by 2%. So essentially the way to think of it is you can think of the existing share class as that 2% dividend getting reinvested on your behalf in the fund. And investors will be allowed to switch between them. They can spread the amount that they have between different share classes. And again, one of the benefits of size is that we now are big enough to be able to do that very easily, and which has been requested for some time by some investors. To answer the other question, which is the multiple share classes, we still only have 2 share classes, the A's and the B's. The other share classes that some of you have seen in the legal documents that we've sent recently are purely administrative share classes that help us, for example, share fees with Diraya and the example I mentioned earlier, and with other people who have helped us with marketing and placement where there's some fee sharing arrangement. But from the investor's point of view, they're identical to the same share class. So there's nothing special about it. And as always, which is mentioned in the PPM, our PPM prohibits us from giving any liquidity preference to any share class, regardless of investor size, regardless of who they are. Nobody is allowed to exit or enter faster than anyone else. And I think we addressed this question when we talked about Diraya and what's the marketing strategy and where we think AUMs will be. Like I said, Diraya is going to provide us with a lot of growth in the GCC region. We're exploring other arrangements elsewhere. We've been receiving a lot of interest from institutional investors, especially in the US, who have seen our numbers in these databases. And we're also looking into potentially launching a UCITS vehicle in the next 12 to 24 months in order to be able to better market in the EU. We're now at 55 or 56 million in assets. Our goal for the next 2 years is 100 million. I think we are probably going to hit that goal before that, but we'll see how things evolve. Again, the bulk of the growth so far has been from people, our partners like you, referring others to the fund, and that's the preferred way for us to find new partners, because they come knowing what they're getting into. They're already part of the family, essentially. I'm going to go through the email ones unless someone raises their hand, if you don't mind, just because of time. Why is Mayar Capital based in London and most of your investors are from the GCC? And combined with that, as the team has expanded over the past 2 years, what do you expect to happen the next 2 years? I think since day one, I've thought about Mayar Capital as a global firm. I've never thought of it as a regional firm. And that's not only because of our mandate. And London is an excellent place to have a hub in terms of how deep the talent pool is, access to service providers, time zone, travel connections. It's an excellent place to be a strong hub for us. But at the same time, we've had essentially satellite offices over those few years. As you all know, I spend a substantial part of the year working from my office in Al Khobar in Saudi. And we'll probably have more of these around the world as technology makes it much more easier to collaborate across geographies and time zones. Is there a point when you will stop outsourcing some functions? If you had an extra 250,000 in OPEX, what would you spend it on? What are the plans for expanding Mayar's infrastructure? I think we're getting close to, if not now, then as we get close to 100 million assets, we're getting close to the point where from a financial, purely financial point of view, it may be cheaper to in-house a lot of these services. That being said, the biggest benefit for us from working with partners and who are providing us with these services is the tremendous scale advantages that they bring to the table. They've enabled us to grow much faster than if we had to build the team in-house fully. And then they also provide us with a much deeper access to talent than otherwise. So I'd be reluctant to in-house a lot of functions. I definitely don't want to in-house fund administration because I think having a third party doing fund admin acts as a security valve and a layer of protection, a check and balance on us for the benefit of investors. The one area we've significantly underspent and we could definitely spend more money on is marketing. And so if we had an extra 250 in our budget, we'd probably spend more money on marketing and growing our assets. But that's always been the least in terms of priority for me. Now we're getting to the exciting stuff. What do you think the impact of MiFID II will be, and what are your plans for purchasing research? MiFID II is a set of regulations out of the EU, and they impact us because they impact Mayar Capital Advisors, which is based in London. And part of it is what they call the unbundling of research. And so traditionally, when you trade through XYZ broker, they also give you access to what is known as sell-side research. And one of the things that MiFID II did is unbundle that service, forcing providers to separate the two and charge different prices for them. So in theory, execution costs should go down and research will be charged and priced explicitly. As you know, we don't use much in terms of outside research. We mainly do our own primary research. So in theory, and again, lots of moving parts still, our execution costs should come down. And because we don't buy that research or won't buy a lot of that research, our overall administrative costs as a fund should go down. The more interesting byproduct of this, and as we've seen the past few months, the explicit costs some of the banks have been saying they'll charge has come down substantially, in some cases by an order of magnitude. If that is the world that will unfold, a natural outcome of that is that fewer companies will be covered by research firms and fewer analysts will cover every company. And in that world, people who do primary research like us will benefit from being able to find companies that are off the radar, essentially. And so that's the exciting byproduct for us from MiFID II. Any more questions? Mark?
As you've grown your assets, can you talk about sort of any trade-off that you've faced between needing the assets to cover the operational costs comfortably of running your business and allow you to make stress-free decisions, and having to be very selective with the right quality of limited partners that are, you know, that are aligned with your investment philosophy and strategy?
I think that question matters if you're playing the short game or the long game. And we've always played the long game. We could have grown a lot faster, and we were just trying to get to a certain number quickly, and no matter what. We've been very selective in who we accept as partners. But it's a tricky question. I think we've also been lucky in that things have worked out in the way that we have worked out, and a lot of our partners have referred people to us who are like-minded and fit within our philosophy. And so I don't want to say that we're always going to, in a parallel world where we 6 years in would be managing 5 million, I think I may have answered the question differently. There is you can wait for only so long before you have to accept anyone who walks through the door. All right, I think in the interest of time, we're going to wrap it up. I want you to leave here with 3 main takeaways. The first thing is to remember that our success, all of us, whether the team, the partners inside and outside, rests on 3 very important pillars: our principles, our strategy, and our checklist-based investment process. The second takeaway is we've been there. Our approach has not only helped us weather storms in the past, 2001, 2003, 2008, 2011, 15, 16, but more importantly, guided us to capitalize on those environments to the benefit of all of us as partners. That's the second takeaway. The third takeaway, which is also important, is that in a volatile and uncertain world, I think the most important thing is for us to continue to stick to our disciplined, long-term approach to investing, but also to continue to be both conservative and opportunistic in how we approach the investment environment. Thank you very much.